Now, let's go to the second case study. This is a real conversation between two traders. Trader A. We should focus on something and trade accordingly. At the end of the day, trading is all about winning probability, okay? So high winning probability is our edge. So trader B answers, I don't think so. Question, who is trader A? The answer is, at least you know I am not trader A. If I'm trader A, I shouldn't be able to speak here, okay? So, winning probability is not your edge, okay? Winning probability is just a part of the game of risk taking. Remember, other than winning probability, what also matters are when you lose, how much you lose. And when you win, how much you win. Think about it. So it's basically this formula. It's this expectation, mathematical expectation formula, right? Think about it. If I take a trade, I only have for me, trust me, a lot of very successful hedge fund managers in the world have a winning probability less than 50%. Less than 50%. Why? It's because we use stops. Once we need to cut loss, this dramatically decreases your winning probability. And we still can make a lot of money. Why? Think about it. If I only have 30% winning probability, each time I lose 100k US dollar. Okay? Each time I win 500k US dollar. Then please do the math. So what should you expect me to win or lose per trade? It's easy, right? 30% times winning probability is times 500,000, right? Gives me 150. And minus 70% times 100k, 70k. So you should expect me to earn 80k per trade, agree? So if I do 100 trades, you should expect me to earn how many? 8 million US dollars, right? That's why you don't necessarily need high winning probability to become successful investor. Two areas. How much you win when you win, and how much you lose when you cut loss. The third case study, okay? The third case study, then I tell you why size is very important. So now you understand. Mathematical expectation, positive expectation is crucial to be successful as a trader, right? Winning probability is not important. The key is mathematical expectation. If you have positive expectation, that's in hedge fund terms, we call that alpha, okay? Or edge of your trading strategies, alpha, okay? That's called alpha. So, then let's do this case study together. Think about it. I have a river here. Okay, in front of you there is a river. The tons of gold and diamond here in this chair. Okay, assuming first you can't swim. Okay, you can't swim, and from your mouth to the bottom of your feet, the height is 1.5 meters high. Okay, you can't use any other tools, so you have to jump and swim and walk here. You can't swim. So basically, if the depth of the river is higher than 1.5, you are going to drown to death. Okay? So now we have a lot of gold, lot of diamonds sufficient to pay you for 3 lifetimes. I tell you, the river, the average depth of the river is 1.3 meters. Okay? Is 1.3. Now question. Remember, your height is 1.5. Are you going to come to take the gold? Will you? No. Anyone say yes? Nobody say yes? Anyone don't have idea? So,
sure.
You should come.
Yeah.
Okay.
Because you have several times to try. Can you go back?
If you come into the river, it's more than 1.5, you die. Fortunately, life can't try. Huh? That's good. So I understand what you mean. So actually, remember, average depth is 1.3. Doesn't mean everywhere it is 1.3. Agreed? So actually, if the river looks like this, you have more than 1.5 here. Average is 1.3. If you jump in, then you die. This is against what? Why you shouldn't do it? This is against my principle number 1, right? When you take risk, you have to first ensure what? Your survivorship. If you are not 100% sure you can survive, don't do it. Okay? Don't do it. Even there are a lot of gold there. Okay? Don't do it. So, from this case study, I want to tell you one thing. What is average? Average average is mathematical expectation, right? You learned that in your statistical classes, right? You students from Hong Kong, you should know that. Okay, so one thing in probability I would like you to understand. Expectation or average is meaningless if you only trade once or twice. Okay? If your sample size is too small, it is nothing, it's nonsense, right? Even if I have a positive expectation, I can have 3 losses, even I have 70% winning probability. It's natural if you trade enough time, you will have 3 to 5 losses in a row. Lose, 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 lose. Just because luck, bad luck. Okay? Just because of bad luck. Mathematical expectation is only meaningful once you are able to trade a big sample size, say 100 times, right? Then, probably you learned that in your math school, the law of the big number or central limitation theorem. Did you learn that? Anyway, the law of big number will ensure you that you will get the average. And the standard deviation will be limiting to 0. Okay, that's basically the same. So therefore, even you have a positive expectation, so you do have a trading edge. Okay, but if you trade too big, you can still blow up. Think about the following example. Say you have 100. You have a 70% winning probability, very high, and you do have a positive expectation. Okay, you do have an edge. But you risk 20%, okay, of your capital. Say you are managing 1 million, so each time you risk 200K. Unfortunately, this time, you have bad luck, okay? And you have 3 losses in a row, which is very normal. Trust me, you have 70% winning probability. If you trade enough time, you will face this, for sure. 3 losses in a row. And you can see, first one, you lost 200K. Second one, you lost 160K, right? The third one, you will lose 128K. In total, you lose what? 488K. Did you blow up? Remember, I told you, 30%, you blow up. You blow up. Right? Even you do have a trading edge. But if your size is too big, you can still blow up. That leads to the principle number 4 I want to tell you. To win in the long run, you need to trade proper size in order to survive the bad luck time, okay? You have to ensure your survivorship. So your size shouldn't be too big. You can survive the bad luck time, and therefore, you can wait until the law of big number plays its role, okay? Remember the formula. Exit is very important for risk management. And now you understand why size is also very important for risk management. Now, I have a question for you. What do you think about the following suggestions? Trust me, a lot of traders in real world, they trust this. If you have trouble, then double. You understand what does it mean? So if you go to Macau, you bet. Big or small, okay? Big or small, very easy. So first time you bet $1. If you lose, the next time you should double. You bet 2, okay? If you lose, you lose totally 3. If you win 2, lose the first one. In total, you still win 1, right? If the second time you still lose, the third time, how much do you need to bet? 4. If you bet 4, if you win, minus the previous $3 loss, in total you will still win 1, right? So if the third time you lose, the fourth time you should bet 8, like that. This is called, if you have trouble, you double. Now, question, what do you think about this?
Depends on the size.
Depends on the size?
Yeah.
Okay.
Because on average, I gave you quite a lot previously. So on average, actually it's very hard to lose in a row for 6 times.
Okay.
Depends on the size. You have to survive even to lose 5 times or 4 times. So
Okay.
that's okay.
And trust me, I have seen 10 losses in a row. Yes.
I would say that if you have like limited amount of capital, then you always win. But the thing is that we have like limited amount of capital, so at some point you're gonna lose everything.
Exactly.
That's what's happening in casino when you play blackjack like this, because at the end you don't have enough.
Did you go there very much? I'm just kidding.
I use this model for.
Okay, very good, very good. So here, these people also believe in this principle. Jerome, okay, So J, he believes in this principle. He's a Delta 1 trader. he lost 6.9 billion US dollar, big time blow up. And this guy, UBS, at the Bali, 2011, he lost 2 billion US dollar, okay, for the company. He also believes in this. You have trouble, you double, okay? You know what? At the, this guy, at the Bali, before he was arrested, in his Facebook, he posted, "I need a miracle." Seriously, he really did. So, actually, I don't think he needs a miracle. He really needs to understand how to manage risk. Okay, this is important. So, why this is wrong? Because you are against the principle I just mentioned, right? So once you double, as he mentioned, your amount of money you are managing is limited. Once you have multiple losses in a row, once you double, your size will automatically increase very fast. Let's take a look at the following example. You have a 1 million. So you risk first time only 3%. 3% is a legitimate number, okay? It's a legitimate number for you to trade. And you lost 30K. You have a 70% winning probability. Unfortunately, you have only four losses in a row, okay? The first time, so you can do the math for me. The first time you lose what? 30K. Second time, 60K. 120. 240. In total, 450K. Did you blow up? Yes, more than 30%, you blow up, right? This is just to tell you this is a rubbish suggestion, okay? Don't follow it. And this is one more thing I want to tell you. In whenever which area you want into, right? You become a trader, you become a sales, no matter what. Don't trust the advice people give you 100%, okay? Always verify, think, reasoning whether these things are true. I hear a lot of bullshits from many people. Okay, sorry to be blunt. So really think twice of those stupid advice. So, of course, if you risk too small, if your size is too small, say 0.0001%, of course you will survive, but you can't make any money, right? So therefore, you need to strike a good balance. First, you can ensure your survivorship, say 99.9% of probability are going to survive, right? And then afterwards, you can trade enough size in order to win as much as possible. So to do that, for those who love mathematics, I can tell you what you need to do is you find your distribution of your trades, and you find a distribution to match it, and you run a Monte Carlo simulation, and then you will get the answer I just mentioned. Okay? So, but if you don't understand, forget about it. Just remember roughly a rule of thumb. Roughly 0.5 to 3% is a good range of number, okay, each time when you take risks. Okay? This is a good number. So to summarize so far, we talk about how to survive, okay? How to survive. Remember, the key thing is first you need to use initial stock to protect your capital. Agree? The second one is you should get positive expectation. That's your edge. Winning probability is not your edge. A lot of people do the opposite, right? They do, I think you guys know things like accumulator or these kind of things, right? That's typically 90% of the time you win, but that 10% or 5% time comes, kills you. Okay? That's exactly something you shouldn't do. The third one is you have to trade proper size to survive the bad luck time. And therefore, you can explore the trading strategy to your full potential. Okay? So then, remember I said there are two parts of a core competence as a trader. First is ensure your survivorship. I already talked about that. The second, I'm going to show you how I beat the market. Okay? How to beat the market. This is, I just mentioned, sheep get slaughtered. Okay? Don't underestimate the market. So, my story continues. This is a question for you. Now you understand how to ensure survivorship. My question for you is, if you were me, think about it. What is the first question? What was the first question I asked my boss after I become a trader? What was the first question I asked my boss after becoming a trader? Anyone? Any idea?
What's my capital to trade?
What's my capital to trade? But in a bank, you don't have capital. It's not like a hedge fund. So basically, the resources You have risk limits, but the resources are pretty much there for you to use if they trust you. Yeah?
My leverage.
My?
Leverage.
Leverage. Your leverage, okay? If you use stop order, initial stop order properly, leverage is no problem. That's the question I ask. How much money can I lose before I get fired? That's really the question I ask. That's a fair question to ask, right? Remember, you need to ensure what? Your survivorship. So that's the first question I care most. How much I can lose before I get fired? So I can control my risk so that I never get fired, right? So you need to ensure your survivorship. That's exactly the question. I really asked this question. And the answer I got, when you were junior, I can lose roughly 500,000 US dollar. After that, I get fired. But now I can lose much more because I'm much more senior and they trust me that I can come back. So this is the first question I ask, okay? And the second thing I suggest to you is this. I already mentioned this, 潜龙勿用, the dragon eating deep water is not time for action. This means you have to get prepared. I've already mentioned that, right? At the very beginning, when you do something new, it's not the time for you to shine. It's time for you to get prepared, to study, okay? And the second thing I want to emphasize is this one. 知行合一 is unity of knowing and doing. This is important. This is coming from a Chinese philosopher, Wang Shouren, in Ming Dynasty. But I personally think this is fabulous. This is fabulous. Trust me, I told you, I read how many books? More than 30 books. And I can tell you 90% of the things I have read, studied are rubbish. Okay? Most of the things doesn't work once you apply to reality. Put every single assumptions, your theories into reality and verify these theories. This is an important step for you to really know what you are doing. If your assumptions, your theories, once applied to the reality doesn't work, it is rubbish, okay? Throw it away. Like many things you learned in your school. Like market efficiency theory. What a rubbish is that, right? Actually, I tell you why. So everything needs to verify in reality. That's the very important thing. So actually, I tell you how I did it. This is how I actually really build up my trading strategies. First, what I did is actually the following. So, in trading, there are multiple ways, okay, for you to trade. You can use fundamental analysis. You can use, so the slowest one, you have a big range of ways to trade, right? The quickest one are those, what we call the flash boys, right? Those algorithm traders. They trade in milliseconds, right? Then do 1,000 trades already. So they're trying to arbitrage the market. So basically the idea is if I can identify your order, I'm a little bit quicker than you, I jump in front of you, she wants to buy, I buy in front of her, okay? Once I get a share, then I have two choices. If the market goes up, I make money. If not, I sell to her. That's what these guys are doing, okay? Very fast, very fast. Also, you can have very slow one, like fundamental traders, right? Fundamental information is, fundamental traders are, some of them are very successful. Like the one I respect the most is called Ray Dalio. It's the biggest hedge fund in the world called Bridgewater. I can tell you he earned 45 billion US dollar last year. HSBC earned roughly 15 billion US dollar. A hedge fund, 45 billion US dollar, okay, is amazingly good. He's using fundamental analysis. Another guy I can recommend you, his fund is called Oak Tree. Oak Tree, 橡树, Oak Tree. And this guy is trading distressed bond, okay, distressed bond. Also very fundamental. So if you want to invest in his bond, you know what's the lockup period? The lockup period is 10 years. So you can't withdraw any money from the fund within 10 years. So it's really long term. What I want to say is there are different ways for you to trade, right? Each can be extremely successful. But I chose to trade relatively fast. My trades typically last from a few hours to a few days. Why I do that? Think about it. So now I'm at the phase, I want to explore my theory, right? I want to learn, I want to try out things. So therefore, I already know that I'm going to make what? A lot of mistakes, agree? And first thing, remember, mistake is your golden source of learning. So I always believe, as I said before, unity of learning and doing. So you have to apply all your theories into reality, make tons of mistakes, and learn from them. So I am prepared to make a lot of mistakes. So the reason I trade very frequent is because I can make as much mistakes as possible in a certain period of time, which is essential for me to survive as a trader. Remember, I said most traders get fired within the first 5 years. You know why? Either because they blow up big time, they get fired, or if after 2 years you still can't make money, probably you will get fired as well. So I have only limited time to try out my strategies and finally to find a correct one. So I need to trade as fast as possible, right? In order to make as mistakes as fast as possible in order to learn. This is a principle I want to share with you today. The principle of making mistakes. Make mistakes wisely. If you do something new, like starting a business, you become a trader, you become a new sales, trust me, you are going to make a lot of mistakes. It is inevitable. But first, mistakes are the golden source of learning, okay? And second, what you should do is instead of trying to avoid mistakes at all costs, you should expedite the procedure of making mistakes. You should try to make mistakes as fast as possible, so therefore you have a lot of chances to learn. Think about this following scenario. If my colleague, Janan, is as smart as me, okay, we're equally smart, and he used fundamental, he trade 2 times a year. I trade 300 times, he trade 1 time a year, easy. I trade 100 times a year, equally smart. So it means after each trade, we learn exactly the same thing. 3 years later, who is much better? Of course me, right? So he only trades 3 times, I trade what? 300 times. I get much more experience than him, agree? This is exactly what I mean. So to make mistakes wisely. So instead of avoiding it, you try to expedite it. That's very important. I can give you another example for sales. You know how to train to become a good sales? If you can't sell well, the suggestion is you apply another job as a sales. Do cold calling. So you do, the other people meet 5 clients a week, so probably you're going to call 300 people a week. So by doing that, of course you make a lot of mistakes, but gradually you experience, right? How to talk to people, how to emphasize the most important thing in a quick and understandable way. Those kind of communication skills can be grasped very fast, right? You need to expedite the procedure of making mistakes. This is one of the principles I would like to share with you as well. So that's why I personally chose to trade relatively fast. So therefore I can learn a lot compared with the others. So I have one question for you. One question. Also, of course, I trade very small at the very beginning. Why? Because I need to ensure the survivorship, right? I trade very small. Some traders I know, they trade. You know, they trade once, fail, twice, fail, 3 times fail, they give up. They try another idea. Is that a good way to do it? Some traders, again, trade once, fail, twice, fail, 3 times fail. Then he try another theory. Is this the right way for me to verify my theories?
No, it's not.
Very good. As I mentioned, you would need to verify is what? Is positive expectation, whether you have positive expectation or not, right? An expectation is meaningless if your sample is too small. And therefore, you need at least 30 trades in order to say something about your trading strategy, agree? So this is very important. So this way doesn't work. This also justifies why I have to trade very fast. Because to verify just one theory, I need at least 30 trades, okay? I need at least 30 trades. So this period for me was a very troublesome, exhausting period. I tried many things. You can name any technical indicator you know. Probably I have already tried. I tried even to build my own technical indicator, and almost all of them didn't work. Okay, almost all of them didn't work. Some of my trades, survived a very volatile time. So 2011, when the European crisis happens, right? Like last year when China has this V shape, those period of time I can do very well, but when market was quiet, it doesn't work anymore. So I tried many things, made a lot of mistakes. So finally, I come up with the strategies now I have. So now I believe I do have edge. I have more than 1,000 trades, and I got a Sharpe ratio of roughly 4. So it's a very good number. So I hope you understand what's Sharpe ratio, right? If I control my risk for roughly 10% standard deviation of return per year, you should expect me to get 40% return on an annual basis. Okay, this is Sharpe ratio of 4. So I then realized technical indicator doesn't work. For all your trading strategies to have the edge, to have the positive expectation, it must be built on market principles and logic. Okay? Only those market principles and logic can help you to build up a strategy that can last very long. My strategy, I personally believe, as long as the market is there, they should hold. Based on the following principles. The first principle I tell you is a trend. Remember, a trend has a high chance of continuation than reversal. Okay? Remember this. A trend has high chance of a continuation than reversal. The logic is very easy. The whole world tends to trend. Think about it. Mainland China has been trending up for what? 30 years till now. It is still trending. So why? If a good company, think about it, if a good company like Apple, if it's doing good, the products are sold very well, then you have what? You have money, right? You have money, you can hire the best engineers in the world. Trust me, one best engineer is much better than you hire 10 mediocre engineers. The difference is huge. So you can hire the best people, right? The best people, you can build up the best team. You can give them freedom to try out new things, whatever you think is helpful for the business, like what Google is doing. You can take the cost, right? And therefore you have much better products, and therefore you generate much better cash flow, and you build up what? A benign circle, right? And think about it, if your company is bad, you start to lose money. So who will go to you first? Of course, the bankers, right? The bankers will help you when you don't need the help. When you need the help, they will take it away from you. Hey, come on. You borrow money from me, and now your income statement looks like shit. So please, pay back. Okay? That's typically what they're going to do. They will come to you. They will chase you. And think about your suppliers. Before, probably you pay them back after 6 months, right? Now, please pay first, and then you get the product. That's why things are getting worse and worse and worse. Then you get into a vicious circle, and that's why many companies go bankrupt, simply because of that. So there are a bunch of guys called total traders in the 1980s. They earned billions of US dollars. They earn money just by following this trend. I tell you how they trade. So basically, the way they trade is very simple. Typically, people, when you invest, people are telling you should buy low and sell high, right? That's easy to say. These people do the opposite. They buy the high of the high. They buy when the market breaks 80-day high. They buy. Okay? When the market drops below 40-day low, they get out. They cut loss. Okay? That's their strategy. Very simple. As you can see here, this is Apple. This blue line is the 40-day low. Okay? And this brown line is the 80-day high. Once the market, you see here, breaks the 80-day high, they buy. And they use this as trailing stop, okay? And you can see here, the market goes down, break here, they get out. These trade, they only earn a little bit, nothing, not much. But here, the market breaks 80-day high again, they enter. And this is their trailing stop. You see? They earned a lot of money. They earned a lot of money. So these guys actually, literally earned a lot of money in the 1980s. They call themselves total traders. But this looks very easy, right? Looks very easy to trade. But trust me, this strategy is very hard to trade. This strategy has a winning probability less than 40%, so roughly 30 to 35%. Think about it. Those strategies require what? EQ. Very high EQ. For me, I personally think to become a successful trader, EQ or anything, EQ is much more important than IQ. People, when you enter the investment bank as a trader, trust me, everyone is smart. But not everyone EQ is high. Think about it, you have only 30% winning probability. So it's normal for you to meet 8 losses or 10 losses in a row. You start to trade. Pia, 1 loss. Second time, third time, fourth time, right? 10th time. You get stuck all the way, 10th. On the 11th, are you going to trade? The same size? Are you going to trade? Probably you will hesitate, right? But if you miss that trade, maybe that is a fantastic trade that will pay out 30, 40 times your cost before. But if you miss that trade, this year is over. So you must have the discipline, right? Even after 10 losses in a row, you still can put into the trade like a machine. So it's very difficult. Some people may say, look, I can use an algorithm to trade, right? But trust me, algorithm is still controlled by what? By human. I know a lot of cases, the algorithm are working, but after 10 losses in a row, the guy said, I don't trade anymore. Boom. This is typical. So this is EQ. So what is EQ? So basically, EQ is emotional quotient. It's your ability to control the emotion, okay? Your ability to control the emotion, like a fear, like the example I just mentioned. Fear is your emotion. You have to use your rational thinking in order to conquer the difficulties. So for me, I think a trader, EQ is more important. Remember, I told you cut loss is very important, right? I know a lot of traders who really have problems with cutting losses. The only reason that people like the rules like if you have double, you have trouble, you double. Simply because they don't want to admit they are wrong, right? So they always want to get in to prove they are right. But trust me, now you learn the importance of a trend. Now you know further why this, if you double, if you have trouble, you double is a rubbish.